By the Fed's own analysis of various policy rules, including the Taylor Rule, the revised Taylor Rule, the Balanced Approach Rule, and the Balanced Approach Shortfall Rule, rates should have begun to rise long before they did. According to the Fed's own analysis of these rules, the Fed's fund rate should currently be above 6%. This is in a report to Congress. Yet the rate currently stands at 1.6%. Likewise, these same rules should have prompted the Fed to begin raising rates Q4 last year, Q1 this year. I'm concerned that the Fed has opted out of rules-based to discretionary monetary policy. As the Fed reviews monetary policy strategy, Chair Powell, will you commit to considering an increased weight for a rules-based strategy in Fed decision-making, and if not, why?
So we do use policy rules like the various forms of the Taylor Rule in all of the analysis that we do. You know, if you're thinking about how monetary policy will affect the economy, you have to have some sort of a rule like that. Fed has never really used them in a prominent way to actually set policy in real time. But that's not to say they don't shed light, and we do consult them. We consult them on an ongoing basis. The rules called for deeply negative rates during the pandemic, and we didn't do that. They did call, of course, for rates to move up, and rates now really are moving up much closer to where the Taylor Rule, various forms of the Taylor Rule are, and I think by the end of the year we'll be pretty close to where some of the Taylor Rule iterations are. So it's something that we consider. I think in a couple of years when we look at our framework again, that's something we could look at.
And Chair Powell, could you just briefly explain the variance between rules-based decision-making being at 6 and where we are today? What other factors came into play?
So what Taylor rules don't take into consideration changes in financial conditions. They just look at the overnight policy rate. As I mentioned earlier, we began signaling, and the way we're set up now to signal policy changes going forward with the summary of economic projections that we do 4 times a year. So markets priced that in, and you're getting a lot of policy tightening well in advance of actually raising rates. As you pointed out, we're at 1.6% only on the federal funds rate, but look out the rate curve. All the very substantial additional rate hikes are already priced in, and they're affecting financial conditions, and they have been for several months. So that's one way of thinking about it. It's really only at the very short end of the curve where rates are still in negative territory from a real perspective. If you look farther out, real rates are positive right across the curve, and that's really what you're trying to achieve with policy in a situation like this where we have 40-year highs in inflation, and we know we need to have restrictive policy, and that's where we're headed.
Thank you. In 2012, the Fed adopted its current 2% inflation target, then amended this in 2020 to allow inflation to run over 2% target so that inflation averages 2% over time. Many warned this approach would simply give inflation a foothold before the Fed could respond. Now inflation's at 6.5% per year, and many serious analysts are predicting a recession. According to the Fed's framework, will the Fed push inflation below 2% so that it averages 2% over time?
No, that wasn't the way the framework worked. And I should clarify, though, the framework was carefully focused on what we knew, which was the economy of the last 25 years. The pandemic hit a few months afterward, and I think we've been aware since reasonably quickly after that the disinflationary forces of the last quarter century have been replaced, at least temporarily, by a whole different set of forces. And those are the forces that our policy has been reacting and dealing with, and we're well aware of that. I think that what we were looking at was a world in which you didn't see inflation move up even when unemployment was for an extended period well below 4%. This is a different economy, different forces. The real question is how long will this new set of forces be sustained, and we can't know that. But in the meantime, our job is to find price stability and maximum employment in this new economy.
And final question is, there is some renewed discussions about increased spending and increased taxes through reconciliation. Just hypothetically, If Congress were to pass a bill that increased spending by $500 billion or $1 trillion and raise taxes, would that make your job easier or more difficult?
I swore off getting involved in these fiscal debates a year or so ago, and I'm determined to see if I can't stick to that. But remember, we can always incorporate. What we do is we take fiscal policy as given, and we react appropriately.
Well, then maybe instead of policy working through Congress, but policy that was passed by Congress, do you believe that the $1.9 trillion spending package last year had any effect on inflation?
This is really not our job to pass judgment. We didn't pass judgment on the Tax Cuts and Jobs Act or the CARES Act or that act as well, the ARP. So I really think that's a job for Congressional Budget Office.
Thank you, Chairman Powell.
Thank you, Senator.